Hey guys, so we're here to talk about a new piece of legislation that has passed on July 4th, 2025 on Independence Day. It's the One Big Beautiful Bill Act, or OBBBA, if you're looking for an acronym there. Basically, it brings in a lot of change, but it also kind of keeps things a lot of the same as they are already. So they're very much a continuity of the 2018 Tax Cuts and Jobs Act. A lot of the stuff you see in there will kind of roll forward into the future for the next 10 years. But the items that we do want to look at are pretty significant. And it is a very large document. It's over 900 pages, and in order for us to kind of get our arms around that, we're going to break it up into chunks. We'll look at individual taxes separately from business taxes. I'll do that in a separate session. And even within the individual taxes, we're not going to try and cover everything all in one go. It's just going to be a little bit overwhelming. So we'll start off with following the format of the tax return, and I think what we'll do is just start off on our itemized deductions, because that's where we're going to get a pretty good focus on the items that we can deduct and that we're used to seeing in the old days being deducted on our taxes. Let's just start off with saying that the standard deduction remains. It still stays at $15,750 per an individual, and that's $31,500 for a married filing joint couple. That is still available, and it will likely still be used by most taxpayers. So with all of this, we're still going to have most taxpayers taking that standard deduction. The other kind of main items within your itemized deductions have some changes, and some have a lot of changes. So your medical expenses, for example, have not really changed that much. They're still going to be deductible in excess of 7.5% of AGI. So if you have $100,000 of adjusted gross income, you have to spend more than $7,500 to be able to take a deduction on your next dollar. So that didn't change much. And what also didn't change much was the mortgage interest deduction. So that stays at a principal loan amount of $750,000. So you can take the interest on $750,000 of mortgage debt. What did change though is that you can now claim your mortgage insurance premiums as deductions as well. So you'll remember we did that a couple of years ago. Well, now it's back, and you can claim those as deductions. The two areas that did change significantly, and then there's one new one that I'd like to add, is the SALT deduction. That's your state and local tax deductions. And the other area is charitable contributions. Those changed significantly as well. The new area that I'm going to cover is interest on auto loans, which is kind of an interesting development. So let's just kick off first with your state and local taxes. You'll recall that under the Tax Cuts and Jobs Act, those were capped out at $10,000. So any tax that you paid to the state as an income tax, or to the county as real estate taxes on your home, those were capped out at $10,000, and a lot of people didn't really qualify for itemizing because the standard deduction typically was in excess of that $10,000 amount. What you're finding now is that has been increased to $40,000, so it's a big number, but there's a couple of caveats to that. $40,000 is definitely going to push a lot of people into itemizing. The main kind of restriction on that is that your adjusted gross income of $500,000 or more is going to preclude you from benefiting from that deduction. What you're also going to find is that $40,000 is linked to almost to inflation. It's actually going to increase by 1% over the next couple of years, and then it phases out after 2029. So after 2029, we would not expect to see that $40,000 being available. We would revert back to the $10,000. So what does that mean for tax planning? Well, let's think about it. If we're receiving a W-2 and now we have $20,000 of real estate tax or another $20,000 of income tax at the state level, we now can claim both those amounts, $40,000, and it makes sense to then itemize. If we're a business owner and we're already using the pass-through entity tax deduction, does it still make sense? And this is where you need a little bit of tax planning, right? So if I've got a business and I'm currently able to deduct, let's say, $50,000 of state tax through my business, through my S corporation or partnership, my flow-through business, at what point does it then make sense to choose to itemize versus maintain that status quo, because you're still able to use your pass-through tax structures? So it's going to require a little bit of tax planning, and that's where your friendly CPA comes in. He should be able to help you navigate that and decide what your best options are. Okay, so let's deal with the charitable contribution section of our itemized deductions, because we've got a few changes coming in there. First of all, there's an above-the-line deduction under OBBBA. You can now claim $1,000 per person above the line, so basically you get the full deduction for those contributions, and that's separate from itemizing versus standard. You get that one either way. So a lot of people who don't traditionally contribute larger amounts will still be able to get a deduction for those contributions that they do make. Where we do have a fairly significant change is that the principle now of 100% of charitable deductions being able to be claimed on your itemized deductions has fallen away. There is now a new 0.5% floor on the amount that you can claim on your itemized deductions for charitable contributions. What does that mean? If I've got $100,000 of cash that I'm going to be donating to my church, the first $500 is not going to be deductible. That's basically what it is. It's it's not a huge amount for your mid-sized taxpayer, but for those that are contributing in the millions, it does have a sizable impact. So at that level, we would probably start looking at things like donor-advised funds or accelerating contributions to foundations, basically trying to bring forward or bunch your charitable contribution into 2025, because this law only kicks in 2026. So you might see a couple more of those kinds of strategies coming into play, but for the most part, your average taxpayer, if they're going to itemize, is still going to continue to be able to claim most of their deduction, just that 0.5% not being available. Just by the way, this doesn't impact at all for those retirees that are contributing or making contributions from their retirement accounts to their charities to meet their RMD requirements. That piece of the legislation stays intact, and there's absolutely no change to the ability for you to take those deductions. Last piece to cover, the interest on vehicles. So there's a couple of caveats here. First of all, there's going to be a $10,000 deduction of auto loan interest that you can claim. The caveats are that it has to be a personal use vehicle, so we can't do anything related to our businesses there. And the vehicles also need to be assembled in the United States. So, it doesn't necessarily have to be a US brand like Ford. It just has to be assembled here. So you could have a Volkswagen assembled in Chattanooga. That would qualify. So the loan has to basically be originated in 2025 or onwards. Although here's another tax planning tip: if you refinance that loan and the new loan balance does not exceed the original loan, you can then use that loan to qualify. So you can also see everyone running to the banks or their lenders and getting that financed again. So that covers the itemized deductions. I think there's still plenty of other items that could technically fall into this category, but we're going to cover those in other sections.